Hi friends, welcome back to my YouTube channel. I am CA Pritish Burton and today we are going to talk about how to choose a mutual fund. I keep getting questions from so many of my clients and friends as to how to choose a particular mutual fund. You switch on your TV, you log into your Facebook page, you keep getting advertisements after advertisements as to invest in a particular mutual funds. Then you have the investment advisors giving you so many advices as to invest in a particular mutual fund. But as I always keep saying that it is your hard earned money and you have to choose your mutual fund or your investment. So stay tuned and watch the video till the end so that you get a complete idea as to how to invest in mutual funds. Now let us look into the various factors that decide or help you decide in choosing a particular mutual fund. The first and the most important factor that is going to decide your investment is the time horizon or the time that you're going to stay invested in mutual funds. While deciding the time horizon, it is important to have goals. Without goals, there is no investment. You need to have short-term goals as well as long-term goals. You need to have negotiable goals and non-negotiable goals. Buying a car is a negotiable goal, whereas buying a house or getting your children educated is definitely a non-negotiable goal. If your goal is short-term and non-negotiable, then you should opt for debt mutual funds. If your goals are long-term, then of course you need to choose equity mutual fund. And always keep in mind that you should not do any panic selling. Now these are COVID times and what could happen is the market could get lower. So in case of long-term equity mutual funds, you need not worry because the market is going to build pace and your investments are going to give you better returns. So having decided your goal, now the time is to analyze your risk. In my first video on mutual funds for beginners, we had discussed in depth about the types of mutual funds. So in case if your appetite for risk is high, then you need to choose an equity mutual fund. In case if you are not so aggressive and your appetite for risk is a little less, then you need to choose a debt mutual fund. Whereas in case if you stay in the middle, then of course you need to choose a balanced or a hybrid mutual fund. So without knowing the risk factor, never invest in any mutual fund. So it is very important to know your risk appetite and then only invest. Let me give you an example. You and your wife have been planning to go to Mauritius from a very long time. You invest in the equity markets and then suddenly the markets drop drastically. Then you can just imagine in what kind of a soup you are in, right? When some of the clients come to me to file their IT returns and I look at their mutual fund statements to file the capital gains, I get really surprised and then I ask them this question: how did you choose a mutual fund? They just give me the simple answer. They go to some website like Money Control and ET Now and they choose the mutual fund based on the highest percentage of returns, which is absolutely incorrect. There are some more factors which should be able to help you out in deciding the right one. The next factor that plays a role is the expense ratio. The expense ratio is the fee that is charged by the asset management company for the administration, management and promotion of the mutual fund. So in case of direct mutual funds, the expense ratio is less. So before investing, you need to choose mutual funds with a lesser expense ratio, which will give you a better return. The next is the consistency of performance. In case if the mutual fund has performed consistently over a period of time, say for example, for the 5 years, it has seen an upward trend. For first year 10%, the next year around 10.5, 11, 12, 13%, then you need to choose that particular mutual fund than which has given a higher rate of return, say 18%, whereas in the next year it has given 5% and in the third year it has given negative returns. So the consistency of performance plays a very vital role in choosing the funds. So do your research, do a little bit of due diligence before investing. The next factor is the fund manager. Why fund manager is important? You might ask me this question. Because when we invest in a mutual fund, we do not look at the fund manager, the other aspects. We just consider that we are investing in an SBI mutual fund or an ICICI Prudential or HDFC mutual fund, completely ignoring the other aspects. The fund manager is the captain of the ship. He is the one who builds the portfolio. He is the one who decides when to buy and sell stocks. So it is very important to consider the fund manager's role. So you need to do a little bit of research on who the fund manager is. Of course, you're investing in an ICICI mutual fund or the other ones, but the role of the fund manager plays a very important role. He also has to do some of the compliance requirements. Everything boils down to the fund manager. So you can never ignore this aspect, which most of us do. Recently, the SEBI has brought in a new rule that the 20% of the compensation that is to be paid to the fund managers and the other key managerial personnel is to be paid in the form of the mutual fund units in which they are managing. So in this way, you can understand how important the SEBI thinks that the role of a fund manager is. The next is the performance within the category. In case of large cap funds, we need to compare it against the large cap funds of the same category itself. Small cap funds against the small cap and mid cap likewise. Here we cannot be comparing the large cap funds against the small cap or the mid cap funds, and again we cannot compare the sectoral funds against the other sector funds. In case if we are comparing the pharma sector funds, we need to compare it with the pharma funds itself and not the infrastructure funds. The next important factor is the taxes. In all my videos, I mention about taxes repeatedly because the tax planning is very important when it comes to your investment decision. Some people invest in insurance schemes and ELSS in excess of what is required. As per the Section 80C of Income Tax Act, you will be eligible for a deduction up to only rupees 1,50,000 and not beyond that, no matter how much ever you invest. So this is very important because you tend to lose out on better investment opportunities. Do not invest in tax saving schemes in excess of what you are required to do. The next aspect or the last aspect that we are going to talk is the size of the fund. Why size of the fund is important? The size of the fund is important because it becomes easier for the portfolio manager or the fund manager to churn the portfolio. So the size of the fund plays a very decisive role which helps out the fund manager to buy or sell the securities. So the size of the fund is very important because the mutual fund is not allowed to keep excess cash as per the SEBI guidelines. The size of the fund in simple words means that the total assets that are managed by the mutual fund. So in case of short-term mutual funds, it is better that you choose a mutual fund which has the size of the fund lesser than 5,000 crores, and mid-cap can be around 5,000 to 10,000 crores, and the large cap funds can be around a little bit higher than the 10,000 crores. So it becomes very easy for the fund manager to manage the portfolio, and that is the way how you choose the mutual funds. So friends, we have spoken about a few very basic points on how to choose a mutual fund, and I hope that this video has helped you out in choosing mutual funds when we have so many options available in the market today. So friends, happy investing and stay tuned for more videos. Keep watching.